The Federal Reserve surprised to the upside at the end of their September meeting with a larger than expected rate cut, and they've penciled in additional rate cuts this year. This may sound like a good thing, and for many people it will be, but there are some troubling things about the Fed's change in direction that we're going to cover in today's video. Let's get into it. At the end of their September meeting, the Federal Reserve decided to cut their Fed funds rate by 50 basis points, larger than the more widely expected 25 basis point cut, putting their target range at 4.75% to 5%. On top of this, they've also penciled in additional rate cuts this year. In the release of their updated economic projections, they now have a median projection of 4.4% for the Fed funds rate by the end of 2024. That means that they would have to reduce their Fed funds rate by 25 basis points at their November and December meetings to get down that low, or one more 50 basis point cut. Now, that doesn't mean that those rate cuts are guaranteed, but that is what they're projecting right now. Obviously, this was good news for the housing market, but the Fed's latest move also raised some concerns for me, and I'll get to those shortly. In my recent videos leading up to this Fed meeting, I laid out some things that needed to happen in order for mortgage rates to go below 6% by the end of the year and give a boost to real estate market activity. The main things were if the Fed lowered their Fed funds rate by more than 25 basis points at the September meeting, and if they penciled in more rate cuts in their updated projections for the Fed funds rate. Both of those things happened, and as a result, we're likely to see an uptick on both the supply and demand sides of the market. Lower mortgage rates improve affordability for buyers as well as sellers that have been on the sidelines who are looking to buy another home after selling their current home. We're already seeing mortgage rates approaching 6%. As of Thursday, September 26th, the average rate on a 30-year fixed-rate mortgage was 6.08%, the lowest it's been since February of 2023. So yes, great news for the housing market, but like I said before, there is a part of this that has me concerned. In my last video, I made the case for why I thought the Fed was going to cut by just 25 basis points. Basically, they had been very cautious about cutting rates in the beginning of the year when they were widely expected to do so. They wanted to make sure that inflation was heading back down to their 2% target, and Fed Chair Powell had stated before that there would have to be some pain in the economy and labor market in order to keep inflation from going back up again. To be clear, inflation has come down considerably from its peak. The latest Consumer Price Index report showed consumer inflation had come down to 2.5% in August, down from its previous peak of 9%. Inflation appears to be under control for now, and the Fed has started lowering rates and started with a big rate cut and anticipated more on the way this year. What's the problem? Sounds great, right? For me, the concern is why they went with a bigger rate cut, and that's the labor market. The Fed has a dual mandate: stable prices, that's the inflation part of it, and full employment, that's the labor market piece. They have now switched focus from fighting inflation to supporting the labor market. That makes sense given where inflation is and the weakness we've seen in the labor market recently. What bothers me is that they chose to go with a big 50 basis point cut to start out their rate cutting campaign, which to me highlights that they're fairly concerned about the labor market. If they had just acknowledged their switch to focusing on the full employment part of their mandate and started out with a 25 basis point cut, that would have been quite reasonable in my opinion. But they chose to start with a 50 basis point cut, which means there is a high level of concern with the recent labor market data. I highlighted the weak points in my last video covering the U.S. economic situation, declining levels of job growth, but also an ongoing trend of revising down previous estimates of job creation. In my next video on the U.S. economy, I'll be doing a deep dive on the labor market data, and it will be an ongoing focus to try to get a better read on where the labor market is headed and if we are closer than previously thought to an economic recession. The labor market is typically typically a lagging indicator, so I'll be doing a deep dive into other economic data as well. What does this all mean for the housing market? Well, in a video I did a while back, I highlighted an economic recession as the biggest risk to the housing market, with the potential to bring about a major correction for home prices. Given the current state of our housing market, a recession would be a big hit to demand and also raise supply. A drop in income from job losses in a recession would put many buyers back on the sidelines, and all the sellers that have been on the sidelines might find themselves in a position where they need to raise cash and stop putting off a home sale. Lower demand and higher supply would be a recipe for lower prices for sure. That scenario is not happening yet, but the implications of the Fed's surprise move for a big rate cut should not be ignored. What do you think? Is the Fed's big rate cut much ado about nothing and they're just being overly cautious? Or do they know something about the economy that we don't, and a recession isn't too far away? Let me know in the comment section down below. I'll be staying on top of all of it for you, so if you want to stay up to date on all the developments in the housing market and economy, make sure you're subscribed to this channel and hit that notification bell down below, so you won't miss my next video on the topic when it comes out. And if you found this video useful or at least mildly entertaining, don't forget to hit that like button on the way out to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.